So with everything that's shifting around in the global macroeconomic environment, trade, how are you thinking about emerging markets today and where are the opportunities?
Sure. Yeah, so we're seeing more and more investors become interested in emerging markets, which is nice. I think we haven't seen that maybe in a few years, and it creates an attractive entry point for investors. And so what we're finding is more and more investors, given the macro environment I think you're describing, Ben, are seeking to diversify holdings away from the United States. Not totally away, but a lot of clients have overweights, intentional or unintentional, to US at this point in time, and so looking for something else. In emerging markets is a pretty attractive setup right now in that there's a few points. Number one, EM sort of had an economic and business cycle already, just a couple years ago. Whereas developed markets was kind of spared from that. The combination of COVID, Fed really aggressive tightening cycle, and then Russia's invasion of Ukraine, spiking food and energy prices, really challenging for the poorest countries in the world. Of course, challenging for everybody, but most challenging for them. So they kind of had struggles, went through challenges, and they're sort of on the road to recovery. We also have a lot of reform stories. Emerging markets is all about turnarounds, and so related, when countries go through these challenging periods, oftentimes the only way forward is to implement positive structural reforms, those policy, quality of economic institutions that I talked about earlier. So we're seeing that in a lot of places. It's really exciting from an investment perspective. Positioning in the asset class is really light. So a lot of investors have fled the space over the last few years. And so to the extent that we are seeing investors start to come back in, more investors coming back into the space could provide an additional bid for asset prices. And then finally, valuations, because of that combination, sort of a tough period for emerging market economies, investors fleeing, valuations are still relatively compelling. So it feels like a good entry point today.
So in every asset class, people debate the active versus passive dynamic. Why active in emerging market debt?
Yeah, active versus passive in emerging market debt. Active all day, every day.
Yeah.
Reasons being is the benchmarks have quite a bit of room for improvement. They tend to be concentrated in our space. They include what I'll refer to as uninteresting assets, and they also include developed market risk. So on the concentration side of things, if you look at like the local EM debt benchmark that
what is in the benchmark for EM debt?
Right. So like if we look at the local denominated one, there's basically 7 countries make up almost 70% of the benchmark. So countries like Brazil and Mexico, China, India, some of the ones, the bigger emerging market countries. What a lot of investors don't realize is that those markets, although they're the biggest and in many cases most well-developed emerging markets, they're also the most volatile. Because when investors are thinking emerging markets, your average investor, they're looking at those countries. And so when it's sort of risk on, they pile into those countries. When it's risk off, they pile out of those countries. And so these bigger EM countries, the capital markets within them tend to actually be the most volatile. So going beyond the benchmarks and including some of these places I was kind of alluding to before can really help manage volatility and also just open up the opportunity set. Uninteresting assets, I think about some dollar bonds in really high quality EM countries. We could argue they're probably not even really EM, like Saudi Arabia, United Arab Emirates, relatively well-run countries. People are not concerned about their creditworthiness, and the result is the credit spreads on their dollar-denominated debt are very, very tight. It's sort of priced for perfection in many ways, and they may very well deserve it, but it might not also be a compelling investment idea if you're thinking about emerging markets. And then the final piece is developed market risk seeping into emerging market debt benchmarks. Dollar-denominated EM bonds issued by, let's say, a sovereign, right, a country, those are issued at a spread to treasuries. They're on the US yield curve, and so you have the treasury component, just like a US investment grade corporate that can change the price of that bond, and then you have the creditworthiness of that country and the spread that can move around and change the price of that bond. And so you explicitly have that US treasury duration driving a good portion of your returns. Historically, the sovereign EM dollar bond index has had 50+% of its performance explained by US Treasuries. And I'm not sure that's what you're looking for when you're allocating to emerging markets debt.
So we talked about
投资一定有风险，基金投资有赚有赔。申购前应详阅公开说明书及投资人须知。